Trust needs to scale in DeFi on a much broader scale. We're at 2% of global wealth. We got what's equivalent to 15% of the world's population holding crypto to some capacity. And there's still people saying, I don't quite trust it yet. We're larger than most other financial markets, isolated in niche market gaps, as we've seen globally. In front of the sovereign wealth funds perspective, even some of the most traditional wallets in the world. If you don't have allocations in crypto, you're market underweight if you have a market neutral portfolio. So it's a very clear narrative out there that we are part of the global wealth pool. We are part of the narrative now. And the reason for that is because we have these safe, sustainable strategies.
DeFi on Solana is gaining momentum, with its speed, low costs, and growing institutional adoption, setting it apart in a crowded blockchain landscape. But what's driving this surge? And how sustainable is it? To help unpack this, we're joined by Ben Nadareski, CEO and co-founder of Solstice Labs. Backed by Deus Ex Capital, Solstice Labs is pioneering permissionless, institutional-grade yield strategies on Solana, making advanced trading approaches accessible to all. Today, we'll explore why Solana is emerging as a DeFi leader, the innovations Solstice Labs is bringing to the table, and what it all means for the future of decentralized finance. Welcome to the Defiant Podcast. Hey everybody, welcome back to the Defiant Podcast. I'm your host, Vinny, and I'm joined today by Ben Nadareski. Thank you for being here, Ben.
Thanks so much for having me, Virginia.
All right, so today we're going to be talking mostly about DeFi on Solana. Can you tell us why you believe that Solana is a great place for DeFi and what sets it apart from other blockchains?
Great question. Solana has been exciting in almost every single metric that you could look at a DeFi L1 from across the industry. When building Solstice and founding it last year, we had the active opportunity to look at multiple L1s to build Solstice across. And based off of the institutional activity, the massive increase in monthly active addresses, the influx in TVL, and most specifically, the stablecoin growth that we've seen even since founding the company, tripling on Solana, Solana was ripe for adoption of attracting an institutional grade yield play. And that's where we entered the market directly. Solana's seen so much activity across the board, even some of those statistics that I'm mentioning on the wallet address side. Solana matched all other L1 and L2s combined in monthly active addresses and led the industry in network revenue for a third straight quarter, just as of recent news. These are some of the basic statistics around why Solana is very relevant to the DeFi industry today.
Okay, and so obviously Solana is known for the speed of the transactions and the relatively low cost. Were there any reasons why this really stuck out, maybe instead of a platform like Ethereum, where I think the biggest chunk of DeFi is currently happening?
Absolutely. Ethereum continues to dominate the flows, as we've seen from a pure numbers perspective. But with that being said, it starts with the security, the latency, the transactions per second optimizations that Solana really hones in on and offers on top of all the other L1s in the space. Real-time stats on Solana across the board. You're looking at 2 to 3 second finality with, sustained 1K to 5K, real TPS bursts in production. This is something that a lot of the other L1s in the space in the current place can't. They don't either have the balance of trade-off of liquidity, of institutional adoption, and these hardware type of optimizations that Solana is offering. So the balance between all of those is really where Solana's sweet spot is. Yes, are there absolute faster, max theoretical TPS numbers, et cetera, out into the market and some other L1s? Absolutely. Are there other platforms and L1s like Ethereum with larger liquidity pools? Absolutely. But the balance between all of them is where Solana really raises the bar and says, hey, we're built for all of this. And the institutions are actually starting to follow this, as we've seen over the last several months here.
Okay, great. And then, lastly, a lot of skeptics have kind of labeled Solana as a meme chain. You're clearly invested in the Solana ecosystem. What would you say to counter that criticism?
Absolutely. As a Solana maxi since 2021, the meme coins is... The meme coins is the main thing why people got involved, because Solana became so immediately user-friendly. It was just so easy for people to use. It was so easy to user interface. The application developers and the developer ecosystem were just pumping out very exciting user-driven applications that people just said, I want to go use this. That's why Pump Fund originated there directly. You have these direct retail applications that are just exploding. And because of the fact that it's fast, cheap, and you're able to do this at a very large scale, And all of a sudden now the institutions are looking at the allocations as they expand their DeFi investments and their DeFi portfolios. And they're saying, we actually want to go get yield opportunity investments into the Solana ecosystem now because of that. So it started with this meme narrative, and that's where it was battle tested. The Trump coin is a perfect example of this, as I always say. Whatever happened with the whole economic dynamics of it is aside, the fact that $12 billion overnight got pumped into a single coin and it did not shut down the network is a perfect example of a battle-tested L1 that can handle that. Almost any other L1 in the space, especially with the liquidity pools and applications, would have broken, but Solana didn't. And so these applications, the meme coin dynamics, it's like a testing zone for the larger institutional applications that has now finally been proven.
Okay, awesome. And yeah, I think that's a really great point. I think there are some people who remember the network outages from years past, and maybe that's left a lasting impression in their minds on, the stability of Solana. So, how do you think about these issues, and how do you see Solana addressing them as they move forward? Do you feel like these outages have by and large been addressed, and you feel confident that that won't happen again?
So the main thing to note there is Solana is also very new comparatively to some of the other L1s that we've seen. So Ethereum's been battle tested since the 2015 timeframe across the board, right? You've seen a huge amount of growth since then. That's a 10-year production cycle. Solana has effectively achieved that market readiness, that institutional readiness, in about half the time that Ethereum has. And so, yes, in the early stages, there were things like network outages, there were latency effects, there was, we looked at the decentralization problem in the servers on the back end of Solana for quite some time, but we've gotten past that point at a faster rate than the other L1 development scales are. So if you analyze any early stage L1, when there's low liquidity, there's a small amount of applications across the ecosystem, they're not going to be ready for the market standard that we've now set and that continues to rise on a day-to-day basis. So in my opinion, Solana's hit that timeline faster than any other L1 in the space. And at this stage in the game, it is institutional ready for a reason, because we don't expect these type of network outages and server failures, etc., that lots of L1 see maybe in the early stages to persist moving forward now that we've hit that point of maturity and stability in the L1.
Okay, and then, we're in a time with a lot of very high quality competing blockchains. We have, Ethereum, Bitcoin, Solana, Avalanche, all vying for market dominance. What do you think Solana needs to do in order to maintain its edge and to continue being, a big competitor in this particular space? So
there's I'd say three angles here. Number one is the one that we've all been told over and over again, that's institutional adoption needs to come, et cetera, et cetera. This narrative continues to pump through. And I'm going to shamelessly shill here, is that's why we built Solstice, is because now that the whole network is ready, stable, and that's the point of maturity, now what we need is large, scalable, and trusted yield-bearing assets to come enter into the Solana ecosystem so that institutions can start pouring money in at much larger levels, hundreds of millions of dollars, billions of dollars of capital for yield-bearing products in the DeFi sector. So that was our market entry. That's definitely one piece on the Solana ecosystem that definitely needs to persist. The second is Solana definitely needs to protect its decentralization aspects. As of this year or earlier, the statistic that I know of is the Nakamoto coefficient in the Solana ecosystem is somewhere around, that 20 range. That is something that needs to continue to improve as we see decentralization hopefully continue to increase in the Solana ecosystem. That is a clear value proposition to the Ethereum piece that they've done right. And with all these institutions coming and honing in on the true principles of DeFi, decentralization always needs to be protected for Solana to really scale. So those two for sure. And the third is going to be around, I will say, the Solana Foundation has been incredibly active in the applications, the grants, the incentive programs for allowing for a lot of these applications to truly be incentivized. But I would say even more so that doubling down on distribution mechanisms across the entire ecosystem as a whole is going to be important for us. It's really important for builders to be incentivized constantly, not just from the foundation, from multiple different pools of liquidity, multiple different protocols, from players like ourselves as well, incentivizing builders. That incentivization wheel needs to continue. That's traditionally where we've seen a lot of the L1s kind of take a halt and say, okay, activity starting to die down, it's because of the fact developers aren't incentivized to build, applications don't really have the liquidity out in the market, and nobody really cares. So we need to continue that incentivization flywheel for all the builders in Solana. And it's been great to date, which is why there's more builders on Solana than practically everywhere else in DeFi. We need to continue that flywheel.
Yeah, brilliant. Okay, let's shift gears to talk about the role of DeFi and yield-bearing stablecoins, specifically on Solana. DeFi has always been one of those places that really attracts more users into a specific blockchain. And of course, we have a lot of movement onto Solana as it emerges as a key player in this space. What do you think makes Solana particularly well suited for people to build DeFi applications on?
Absolutely. So the stablecoins and the yield-bearing products across the board, we've seen them triple in volume on the stablecoin side since last year. We've seen the yield-bearing products grow, but the major issue there is scalability with the growth. So one of the major reasons why we've seen the growth in the first place, to answer your first question, is throughput drives market quality is a standard quote that we use all the time in the Solana space. You have these dynamics of sub-second blocks, parallel executions, and those compress effectively the slippage and MEV windows for a lot of these transactions. So you see top-tier DEXs and PERT volumes and app revenues skyrocket on Solana because of the fact that it's that efficient comparatively to a lot of the other L1s in the space. You also have the fact that there's very low fees for these transactions, especially for lower end protocols and the developing applications and the builders that are working on this. They don't have to deal with high fees for a lot of these transactions, which aggregate over time. You're looking at, it's something like 5 decimals over 2 to 3, 0.10 of a cent per transfer, right? So that way, LPs can effectively rebalance and grind those fees far deeper without any P&L drag. That's a huge benefit for why these applications are being built there. And also, there's a huge aspect of composability as well as the third point for everything going on in Solana. The way that the SPL design is worked, even with the Token 2022 standard, you're seeing a huge amount of composability being introduced, which allows for the creativity in the applications to really persist, which we've all been seeing. Even on our end, we're an SPL token on the Solstice side, which it has a huge benefit on the composability factor. But those are the 3 reasons I would say.
Yeah, that makes a lot of sense. And to stick on the topic of yield-bearing stablecoins, that's really, I think, emerging as one of the most popular things in crypto right now, especially with the Genius Act being passed and so many people finding ways to offer yield to the holders of these tokens, which is very exciting. We love getting more than 0.01% on our money, especially in a year where the dollar is already 10% down on value, right? So what would you say is driving this trend of yield-bearing stable coins gaining traction, and how do you see that evolving with stable coins that are specifically on the Solana ecosystem?
I want to differentiate the yield-bearing stablecoin narrative very slightly, and that's you have this massive influx in the stablecoin side, right? So first and foremost, USDC and USDT dominance on all L1s persists right now, and for very good reason. It's kind of the core stable asset. But the narrative that's shifting in that core stablecoin model is effectively, hey, Tether's the most profitable company in the world for a reason, and Circle's making money hand over fist on the stable coins on the back end fees. None of that's getting distributed to people using the coins, etc. And that corporate model of use our product, we keep the fees, and we just are bullying our way effectively as a market dominant player to say we have the usage and we have the monopoly, that's breaking. So the user need for yield is the core point that's starting to evolve. And that's where this yield-bearing play comes in. So there's 2 ways that affects. So first you have the yield-bearing stablecoin itself, and then you also have other models like synthetic stablecoins, asset-backed tokens, for example, that introduce their own stablecoin to the protocol. You lock that stablecoin up into the protocol for yield, and that allows for composability and how the yield is actually generated. So at Solstice is a clear example of this, right? So we have our USX token, which is a 100% collateralized stablecoin. We allow for all users of that USX stablecoin to enter into our Yield Vault protocol. That Yield Vault protocol on our side is a dynamic delta neutral strategy, and we are able to produce double-digit yields consistently, which we've been doing at the DSX Capital Group level for 3.5 years now. We're able to say, hey, if you guys use our stablecoin, you have a direct access to competitive DeFi yields now. And there's other incentivization metrics, and there's DeFi unlocks, and there's looping and PT systems on the back end, etc. But the fact of the matter is that the core value of participating in the yield is the narrative that's been evolving very, very heavily. So with that, I'll just finish by saying, the core yield that a lot of these original stablecoins that have traditionally viewed as securities have now been separated. And that model, I'll be transparent about it, Ethereum, in the Ethereum ecosystem, Athena's model really championed how the ecosystem has been looking at what a successful product looks like in this space. They came out with their synthetic stablecoin asset-backed token, however you want to classify it. They were able to offer a yield strategy on the back end to that, and it's now grown to $14+ billion of volume, or $12+ billion of volume. This is something that's a huge DeFi unlock. Then you pair that with the Aave lending pools, you pair that with looping systems, you pair that with point systems, and all of a sudden, Ethereum now has its greatest DeFi unlock that Ethereum's ever seen. On Solana, we don't quite have something that scales to that level yet. We don't quite have something that's a yield-bearing asset that can scale with all of these different components. That's exactly Solstice's market entry. So why I'm excited about that is because that market hasn't been addressed. Institutions are on the fringe, peering over, saying, how do we get involved with Solana? And with all that Caminos, Exponents, Loop Scales of the world out there, this is ripe for adoption for large-scale capital to come in.
Yeah, and so, what I'm seeing is a lot of places are taking advantage of RWAs. Right now, the low-hanging fruit is, treasuries, and using that as a piece of collateral to back the stablecoin, not just the one USDC to one USD, for example. But when you look at USDC, we're happy to get 4.5% yield on our holdings there. How are you able to achieve double-digit yield? Is it just a different array of assets that are in the treasury? Or if you could walk me through that.
Absolutely. It's a good point here. So the RWA point in itself, we're going to continue to see that expand. The recent announcement, for example, of R3 and Solana's partnership, $10 billion plus of assets coming over into the Solana ecosystem that has been widespread. I used to work at R3 in the early days, so this is I know the widespread institutional adoption that they're bringing over, and it's massive, and there's a lot of applications that are going to be using this. So the RWA point is no small feat. It's something that Solana is going to see attribute to its growth in a large way. On our side, where we generate the yield is not core RWA products. What we have is a dynamic delta neutral strategy that we've been able to execute. And effectively, we've been able to execute this strategy for the last 3.5 years with a few $100 million, and we're scaling that up for the full market participation now. And we effectively put on the funding arbitrage trade across 15 to 20 spot pairs out in the market across multiple sexes. We also do hedge staking as part of this dynamic delta neutral strategy, where we execute that funding trade while staking the underlying assets of SOL, NETH, or NEAR, and ETH. And we also have a tokenized treasury allocation. Where that slightly differentiates from a core delta neutral play that you've seen out in the market is the fact that when funding rates compress, we can quickly allocate to the staking side of things. We can quickly allocate to the treasury side of things as well. That allows for our yields to be sustained. This has yielded, for example, in the last 3.5 years, a net IRR of 13.8%. In 2024, a net returns of 21.5%. And this year, we're looking already at 13-14% cumulative. And that's all with a Sharpe ratio of around 7. And for those not familiar, that just effectively means the risk that we put on in order to get the yields that we're returning is exceptionally low. Again, it's delta neutral. We're not taking market positions or bets. It's just arbitraging that rate out.
Well, I like the sound of conservative yield being pretty damn high.
That's the narrative. Is these 1% bank savings accounts are not cutting it anymore. And people are realizing that the TradFi model is broken, and people trying to replicate that in DeFi, it's not working either.
Yeah, and I find it kind of interesting in the sense that, these traditional savings accounts or high yield savings accounts and CDs, they're not even keeping up with inflation. So to me, if it's not keeping up with inflation at base, it's not really worth it to me as a financial instrument. And then a lot of people, though, on the other hand, look at crypto as this really scary place to put your money, and they don't want to lose all of their money. And so, do you see what Solstice is doing as a kind of counterpart to that narrative, being you can invest in crypto and it can be more aggressive than TradFi, but you don't have to necessarily be afraid of going broke?
That's exactly correct. Trust needs to scale in DeFi on a much broader scale. We're at 2% of global wealth. We got what's equivalent to 15% of the world's population holding crypto to some capacity. And there's still people saying, I don't quite trust it yet. We're larger than most other financial markets, isolated in niche market gaps, as we've seen globally. In front of the sovereign wealth funds perspective, even some of the most traditional wallets in the world. If you don't have allocations in crypto, you're market underweight if you have a market neutral portfolio. So it's a very clear narrative out there that we are part of the global wealth pool. We are part of the narrative now. And the reason for that is because we have these safe, sustainable strategies. So with us, for example, when you deposit funds and we say USX is 100% collateralized, those assets are sitting in copper and Cefu accounts. Now we mirror those onto the exchange, etc., but they do not move from the custody accounts. And when you have those in the custody accounts, you can see real-time proof of reserves, attestations, multiple pricing oracles, keeping the peg sustained. You have all these kind of institutional rails that have been baked into really building and scaling that trust in these protocols. So, Solstice is going to be one of the leading examples on Solana for how large-scale capital can come in at size, trust their assets, see where they are, generate good yields. But on the retail side as well, it's fully permissionless. So principal, protect your capital. Anywhere where there's stagnant capital in your wallet, you can be earning on that in the backside, while then having composability and usability for the stablecoin out into the market. It's effectively your access to DeFi while protecting against inflation.
What a world we can build.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
So stablecoins are obviously a hot topic, I would say, in mainstream conversations, crypto conversations, and in regulatory conversations. And we've already seen several acts passed, which we've been celebrating here in the crypto industry. But from your view, what else needs to happen from a regulatory standpoint for us to really make progress here, to build the tools that we want? And I think to continue on the trust part of this conversation, to help build trust with people who are probably still fearful of hopping into crypto assets.
When regulators look at a lot of DeFi regulation, a lot of the time what we've seen in the past leading up to this date was how do the governments take control over this industry they don't have control over.
Right.
That's traditionally how a lot of these, unfortunately, right? This is the narrative. That's how they start with the regulations. Let's get as most control. Let's stop people from using crypto. Let's have all the reporting metrics, et cetera, baked into it at an over, tax rate, et cetera, in the early stages. We've seen kind of that overstep. Now, what we really need to do is make sure that there's classifications. What governments really should be doing, and their role in the whole world, is protecting individuals from extraneous risks that the average investor would look at and say, oh, I don't know better, I haven't done the research on it, and this is actually a scam underneath the hood, and the assets aren't protected, etc. There should be standards put in place for yield protocols that have the user's best interests in mind, not the government's. We need to start seeing that model evolve. So what would that look like? That would mean, for example, rather than say, like in the US, we're banning all yield-bearing stablecoins. If they're educated, they would actually say, make sure that there's dual pricing oracle structures. Make sure that all the assets are 100% collateralized on the exchanges with attestations. Make sure that there's, real-time proof of reserves for your custody, right? Those are the things that you should put regulations on and say, hey, don't launch a DeFi protocol unless you have these set columns that allow for us to say, hey, any retail user can come in and trust that their assets are being protected. It's a clear just overstep. And the reason for this, it's a miseducation. A lot of lawmakers globally, especially in the G10, do not have the blockchain expertise in any capacity to make the right calls on this. And unfortunately, people that they're hiring and paying boatloads of money to come in and consult for them on, they're not involved in the DeFi day-to-day. A lot of them don't even trade, I would bet, on a day-to-day basis. And I don't mean trade, just interact with DeFi. You really need to be kind of hands on the ground to know what works and what doesn't.
Right. And for more than, a few hours before you vote on the bill, it actually does take time for these concepts, I think, to sink in and for you to really understand how things connect, And so that's kind of where my anxiety about regulation comes, where it's let's be real. The government has not had meaningful regulation for the internet yet, for social media, for AI, like how are we going to get to crypto when we're still not even working on the foundations that have led us to where we are, you know? And I just find it really interesting. Like these people are trying to regulate and control something that they really don't even understand at a surface level.
It is so accurate in the way you said that. The true intentions of government regulations really come out when we see these oversteps. This happens consistently, and which is really unfortunate. It's like you truly see this is purely about power and control and not about the citizens' best interests in mind. This is not about protecting the investment. This is about control over money supply. This is about control over these financial systems. And when the financial systems of today are not working the way that we want to see, and we see bailouts, we see misuse of funds, we see, a constant amount of fraud in the traditional finance industry.
Printing, let's not forget printing dollars every day.
Printing unlimitedly with no backstop at all. That's exactly like all of these things. You put it on chain, you can see it transparently, where are the funds, what's happening, and it solves the issue. That's the transparency is what governments are more fearful of rather than anything else. They're not scared of the innovation side. It's the transparency underneath the hood. That's why AI is running rampant with no regulation on the back end. And we're just going to see what happens when AI gets smart enough and more evolved enough to start, evolving into systems that we don't even know exist yet. These are the type of things that the government really needs to take a view on. And it's not just about the power and control of yesterday. You really need to be future-proofing for tomorrow. And the old game of TradFi is way behind us at this point.
Yeah, and that's where I feel like it's so ironic that people have more trust in TradFi when, let's just look at this year. Let's look at the last 25 years. I have a few questions for those of you who think like the traditional banks are the place to keep your money.
That is so spot on. It's funny on the bank side specifically, it's like when you put your dollars in a savings account, the classic example that people know, well, if you have 100 clients at a bank and 100 of them tried to pull their funds out at once, the bank is not actually collateralized enough to do that. On DeFi,
right,
however,
but the stablecoins have to have 100%.
or over collateralization in some of these cases. It's insane. So there's proof of it, and it's your money, and it's your keys, and you own the funds, and it's all transparently collateralized. Meanwhile, on the traditional side, everyone goes to their traditional banking providers. On the back end, all it is trust on the hope of an existing system. And we've seen them misuse that day in, day out, which is why we've had scenarios like bailouts in the past.
And which is why fiat is the perfect term for that type of money, right? Running on faith. And those of us who have found faith elsewhere, we're rocking and rolling. Okay, so we've talked a lot about stable coins, but I'd love to hear from your perspective since you've been deep in the Solana trenches. Do you see any other DeFi innovations or trends that Solana is ready to take on, or that maybe other people are building, or that maybe you're thinking of building?
So what I really want to see evolve personally is a lot of the different yield components that traditional markets currently have. There's a couple ways to look at what we're doing in DeFi. One is effectively a replication of the TradFi system on day one with much better infrastructures, transparent, permissionless access, etc. All of the different principles that make DeFi so important. But really, this is about optimization for new yield components. So a lot of these yield strategies, like even at Solstice, this dynamic delta neutral strategy with a 3-part system, yes, sure, it's a little bit complex if you don't understand the trading world, but you would have never had access as the day-to-day user to go in and say, I don't trade that on my own. I don't have these accounts set up on all the exchanges. I don't have the time after my work to go in and do this very elaborate trading strategy to really optimize those yields. This is where it is. Solstice, whether if you have $5 or 50 million is what we continuously say, you can access the same level of yields. So with that, what other yields are out there? In my mind, what we're going to expand Solstice into is a number of different yield protocols with varying risk levels, varying return strategies. It's almost like the best analogy I think I've seen in the traditional fintech world when you saw democratized wealth managers come out, like the Betterments and Wealthfronts, a little sliding risk curve. You say, how much risk do you want to take on, right? That was brilliant because that put the power of the investments into the individual's hands, and you kind of remove that third-party middleman of the financial advisory side. Now, yes, on the back end, it's still trading in TradFi systems and et cetera, but it changed that power dynamic over. When people realized they could do that, it was Robinhood exploding. It was all these different fintech apps that started to put back the power of yield generation in the users and the clients' hands. In DeFi, not only have we given that power back at the full scale and permissionless access, we can have all these different yield opportunities that you would have never even thought possible. And to be fairly frank with you, DeFi markets are also not entirely efficient yet. What I mean by that is we haven't hit scales of liquidity adoption out there where natural market dynamics, like the funding rate arbitrage, for example, that's highly compressed in TradFi markets, but it's not in DeFi yet. And so with that, we have a large amount of opportunity to get to that point. If I wasn't in DeFi yet in the world, the first thing I would realize is that point is that the market is not as efficient, which means that there's opportunity for yields in a lot of great places right now. So now that we've hit that point of adoption where the infrastructure is secure and reliable, the yields and the liquidity dynamics are what's coming next. So Solstice is going to be capturing a lot of those different yield plays. And there's a whole stream of other things with quantum computing and AI integrations into the DeFi protocols that I'm very excited to see. And I do think Solana is well positioned to integrate these at a large scale, but the yield components, I think, is the most tangible for the end user.
Yeah, totally. And, as someone who has just recently gotten into yield farming and liquidity pools, I feel like I'm doing my part, with my capital.
Good. As everyone should. Set the example, Vinny. This is like, everyone needs to follow your example here for this. It's important. Well,
for me, I feel like you said, the fact that you can jump into a liquidity pool with $5, you can get $5 of stablecoins, you can get $5 of Bitcoin. I feel like crypto in general is so accessible, that you can really start with money that it really doesn't matter if you lose $5, right? But it's that excitement of, oh, wow, I made 20 cents in 24 hours. What would that be if it were $50, $500, right? So it's I feel like that journey is it's where we need to get people. We need to be pushing them.
Absolutely. It's important to also note this from not just from a first world perspective, but from a third world perspective. The ownership of the funds, there's a whole dynamic. It's a narrative that a lot of us in the industry have been screaming from the rooftops for years. It's in a lot of these systems where the governments are really not trustworthy. I'm not saying most governments are in general, but a lot of these.
I'm going to find out how much Marx you've read right now.
Yeah, exactly. No, I don't want to come off like an anarchist, but what's important to know is the general trust in the systems for a lot of the third world dynamics as well is the fact that they don't have even a safe place to even put just flat cash, not even inflation protected. So crypto's unlocked that for them, and we're starting to see that all over the world. I was just in the Philippines 2 weeks ago talking very heavily about the retail adoption, crypto wallet adoption. It's exploding over there for a reason. And you're able to get these very secure wallets with every single individual in the country being able to now own these. Now, what's the next step? Everyone's starting to own these. They can start to use them in some applications. It's what I just spoke about in the yield dynamic. You need to have these high yield savings accounts, if you want to call them that, to access these yields in a safe way. And this is where we need to evolve as an industry to anytime you see, hey, here's 100% returns or 50% returns, et cetera, these massive, massive numbers, that game is on the past. Yes, there's yield optimizations with small liquidity pools that will drive market efficiencies, et cetera. But the sustainable double-digit yields right now in DeFi is possible on so many avenues, no matter what L1 you're on at this stage. And this is where, the third world dynamic really plays into effect and allows those individuals to get access to yields that they've never had access to before.
Access to any yield, right? People in Latin America are lucky to get pesos in their wallet and maybe get some US dollars for their, savings account, for their moon bags, if we can translate
That's exactly right. That's exactly right. Where you don't have access to these financial advisors or other streams. This is going to be, I think, one of the greatest unlocks in financial freedom that we've ever seen when we hit that turning point. In my mind, when that 15% of global crypto holding turns into closer to 40 to 50%, that's when we snowball, and that's when markets become highly efficient, and that's when the trust factor is no longer, the narrative isn't we need to scale trust, the narrative is we need to build what's next, which is, because we're already past that point of financial freedom.
And then you're just going to have to hire more customer service reps to, deal with all of the people that are using your products,
That's exactly
It'll be awesome. Right. But yeah, I'm obsessed with this idea of people in emerging markets becoming not only owning stablecoins, but then taking that plunge into DeFi when there are plenty of, Gen X and boomers here in the US that could totally benefit from it. But for whatever reason, they're stuck in their, old world ways. So I'm really excited about this idea because something that I've noticed is, why do people love Bitcoin? Why do people love Ethereum? They love things that have helped them to change their lives. They love them because it made a profit for them, And like, I think definitely the reason why I'm so into crypto is because it's become that opportunity to build wealth that I feel like other industries, other jobs, TradFi just doesn't really offer to young people anymore. So, the biggest evangelists are going to be potentially those people in emerging markets who come on, they're like, oh my gosh, I can make money on my money.
That's exactly right. We take it for granted almost in a lot of, call it, major
Definitely
countries. And this is, like I said, it's going to be one of the greatest unlocks in financial freedom that we've ever seen. For a very clear reason. It's going to be personal to people. It's going to be real for people. And at the end of the day, it's not because you've put faith in another institution or even Solstice. We challenge people, don't trust us. Challenge it. Where are my funds being held? Can I attest that? Is it on chain? Where are the yields being generated? All of those strategies, etc. The transparency needs to occur. I just gave a talk on this whole concept, and this was focusing on the concepts of how DeFi is actually going to remove the anonymity in financial markets almost entirely.
Right.
And initially, when we started this, the crypto industry at a large scale on the institutional side, privacy was always a very kind of clear thing that was a value proposition, which also had a dual-edged blade, which is effectively saying, well, a lot of people aren't going to trust it because of that. So where do you draw the line? And what's nice is when you talk about innovative products, to your earlier point, there's some protocols out there that are doing this. They're focusing on the digital identity aspect and the fragmentation of digital identity. So, for example, when you go to a bar, all you need to do is show your ID to get your age verified. But you're releasing your home address, your full name, picture, the whole 9 yards, etc.
Now I'm a organ donor. Oh no.
Yeah. You don't need all that information. Like, why do you need to give all this information to access a bank account? It's a right based off how society works in the world today. Financial independence is a right. It's a human right because it's necessary to live in this day and age. And so with that, you should not have to give away everything to a third party, which misuse and data leak your data. They're subject to hacks. They misuse it. They resell it. And you have all of these systems in place that we've seen get put in, especially with AI integrations now, analyzing, scraping, and viewing and surveilling your data on a day-to-day basis. In the DeFi world, we're already putting in the protections around your even data that gets released, which will really protect the users in a better way.
No, I love examples like this because, for the last, I'd say 2 to 3 years in crypto, there's been this vague conversation about the threat of AI and how can crypto combat it. And I love talking about examples like this, especially when we start talking about zero knowledge proofs and just different ways in which we can unlock KYC without feeling like way too much about me, way more than you need to know for me to just hop in this pool or buy this stable coin. It's not that deep, guys.
It's exactly right. It's just what's necessary. Like I said, we're creating some of the most efficient markets in the world, but with that, the efficiency on the privacy side. And efficiency on the privacy side means that anonymity is going to come at a cost. If you want to go into borrow lend markets, etc., if you want to be truly anonymous, it's going to cost you way more. Capital costs increase, borrowing costs increase. All of these different financial dynamics are not going to be able to pursue in an efficient way. So we're actually going to create a highly transparent system. We're going to remove financial anonymity. But with that, it doesn't mean surveillance. It doesn't mean you don't have access to your data. We've even changed the meaning of of giving away your data in the first place. So the combination of that, I think, is it's a no-brainer for me when it comes to whether if you're deciding, I don't quite trust it yet, when you're talking about DeFi or crypto, or if you're choosing whether or not to invest from an institutional perspective. It should be a no-brainer at this point. Yeah.
I think a lot of these questions have been answered, definitely this year. So I'd love to ask you a little bit more about, the USX token that you guys are gearing up to launch. What makes this token unique, and how does it contribute to the broader Solana ecosystem? So
Solstice is two things. We have two businesses internally. We have our protocol, which I'll talk about, and we also have a $1 billion staking business as well, which does Sol stakings across the world. The protocol business, very explicitly, which is launching as a teaser this month, by the way, in September, with a DApp access, permissionless access to the full ecosystem. It has three components. You have USX, which is a 100% collateralized stablecoin. It is a traditional SPL token. There's no yield-bearing concepts to the core USX token itself. It is just a pure one-to-one backed, and it is backed by USDC and USDT. We're accepting effectively only highly liquid stablecoins as the backing assets for this. So not only is it highly liquid, transparent, fully collateralized, but effectively it is a true synthetic stablecoin, not an asset-backed token that we're hedging on the back end, etc., accepting Bitcoin, ETH, Solana as depository assets. It's a true synthetic. So this USX stablecoin is a core piece of this puzzle. Now, all users of USX will have access to lock their USX up into our yield vault. The yield vault access is only a minimum of a 7-day lockup period, which allows us to generate the yields on the back end. And that's where we do the dynamic delta neutral trading strategy that I mentioned earlier. Mm-hmm. And those yields get passed back. When you lock up your USX, you receive a liquid staking token in return EUSX. That will rise in value as yields get generated. And then you swap back out whenever the time is right for you for your USX. And that whole protocol will be wrapped up with a native governance and utility token SLX, which we'll be prefacing for TGE later this year. What's exciting is this protocol is built in a regulatory structure that is built to scale to billions. And what I mean by that is it's a managed fund on the back end for B2B businesses and KYCs to come in and introduce capital at large scales. We've already generated hundreds of millions of dollars of external capital coming into the protocol, for yield, providing deep liquidity pools and access into Solana markets, but also fully permissionless on the DApp side, which is launching later this month. So the whole quote that I mentioned earlier, $5 or $50 million, that's how that works. You have a managed license fund, you have a core decentralized protocol accessing the same yield pool. And so where this is going to change the game for Solana is two parts. Number one, this is going to be resulting in potentially the largest yield-bearing asset on Solana in very short order. This could happen in a matter of weeks from launch. And that is going to effectively give people the confidence that there's a trusted, large-scale yield-bearing asset on Solana that we can go put our money into. The second aspect is it's going to be the largest DeFi unlock in Solana's history. What I mean by that is effectively, if you want to look at the market competitors to date, on the Ethereum side, different liquidity pools, different user base. You have that Aave Athena pool that drove $12+ billion of market liquidity into the DeFi side. Not only have we replicated the stack of the types of yield that could be generated in that stack on Solana with key partners like Camino and Exponent, Loopscale, but we also have built this in a more transparent and a more competitive yielding way. And the reason for that is because we're going to be capping our funds at $1 billion or so in the first yield product to allow us to continuously capture alpha rather than scale to billions and then lose out on some of the alpha gains as you grow in size past the $1 billion sizes based off of market liquidity for perps and whatnot on the exchanges. So what we're going to do for Solana is twofold on that front in a very large way. And for the broader DeFi ecosystem, you're going to see a lot more of these protocols come out, which is great for all of us in the market.
Well, Ben, this all sounds very ambitious and very exciting. Are there any challenges that you're anticipating? Anything you're a little worried about? Or is the team ready to rock and roll?
Well, now that the Fed cut rates, no. But there's a lot of interesting dynamics here. Like they should be transparent, right? A lot of the liquidity for a lot of these trading strategies trades through single exchanges like Binance. It's a cohort of Binance, OKX, Bybit on our side, but Binance maintains a huge portion of these trading strategies and liquidities. USDC is part of the backing asset. So you still have some of these kind of centralized pockets of trust and centralized places where, that trust gets aggregated to. Now, if those black swan events were to occur in, USDC DPEG or something with Binance, there's a lot more issues across the whole crypto market than just Solstice. But when you build protocols, you have to identify these early of where centralized pools of risks can occur. So we're going to look to offset those over time in every way possible. And we do have a lot of strategies that we'll be coming out with about how to offset those risks. But it is something that all of us in the DeFi industry definitely keep an eye on very, very closely. And luckily, we're expanding in the DeFi side very rapidly, but so are the institutional crypto players, call it, that are coming in and, rebuffering and balancing and building up their trust and security factors on a day-to-day basis. So I would say the biggest challenge is, identifying all of those risks, offsetting those as soon as possible, and also building a protocol at scale in just a few months here. We've effectively done this with hundreds of millions of dollars of capital into a protocol on a permissionless basis in a matter of 8 months with a team of about 35 people. So the time frame for us to do this was short but very, very effective, and that's how fast DeFi is moving.
Yeah, literally. I'm like, oh, wow, that sounds like a lot of time in some ways.
That's years.
Didn't do it overnight.
Eons in crypto. So
yeah, exactly. You're already decades in of experience, relatively.
That's exactly right.
Well, awesome, Ben. This has been so wonderful. Where can our audience learn more about Solstice?
We'll point you guys to solstice.finance is where all the information for Solstice is going to be. And right now, I'm not sure when this will be released, but we're solsticelabs.io right now. And at the public release, this will change over to solstice.finance, which will be the domains out in the public for access to the DApp, access to USX, access to the Yield Vault, and all the supporting docs and partner ecosystems, etc. I would also point everyone to Solstice Fi on X as well, at Solstice Fi, F-I. And then you can also follow me on X as well at Ben_Solstice.
Okay, awesome, Ben. Thank you so much for joining us, and we'll be watching you closely.
I hope you do. Thanks so much, Minnie. It's great being here.
If you enjoyed this episode, don't forget to like this video and subscribe to The Defiant for more content like this. And join us next week when we'll be talking to Aryan Shikalian about tokenized stock momentum, current VC and investing trends, and how tokenization is creating new rails for fintech. But until then, stay tuned, stay informed, stay defiant.